Hey guys, welcome back to the channel. In this video, I want to cover one of the most important topics when it comes to investing in the stock market. And that is, how do you value a stock? How do you figure out how much to pay for Tesla stock or Berkshire stock today? And it's an important question to answer because, as Ben Graham says, a great company is not a great investment if we pay too much for the stock. So in order to find the true value or the intrinsic value of a stock, we need to do a valuation. And I'll be doing a couple of examples in this video with Alibaba and Tesla. The valuation method I'm using today is something I've taken from Warren Buffett, Mohnish, Pabrai and many others. Something called a discounted cash flow. And as always, the spreadsheet I'm using will be available to download for free in the description box. Alright, the first business we'll do a valuation for today is Alibaba. Now before we start, it's worth mentioning that before I even try to value a stock, it has to pass my checklist for being a wonderful business. And more importantly, it has to be a business that I understand. If I don't understand the business, there's no possible way I can accurately value that business. So this is my discounted cash flow spreadsheet, and it has all the calculators built in, so the only inputs we need to fill in are the yellow boxes, and the calculator auto-fills the rest. Now I'll let Warren Buffett quickly explain what a discounted cash flow is before we begin.
The intrinsic value of Berkshire, like any other business, is based on the future amount of cash that can be expected to be delivered by the business between now and Judgment Day, discounted back at the proper rate.
So the purpose of this spreadsheet is to estimate the company's future cash flows and discount the future cash flows back to today using a discount rate. And that number is the intrinsic value. So to start, the first number we need is Alibaba's current free cash flow, which we can get from Ticker. And we can see their free cash flow is roughly 21 billion. It did drop from about 30 billion from the year before, which I'll touch on later. So if we go back to the spreadsheet, we type in 21 billion. Next we need our growth rates. And this is the easiest part of the valuation to mess up and make mistakes. A common thing I've seen people do is to go to something like Yahoo Finance and use analyst estimates to get the growth rates. This is one way to go about it, but I personally don't like putting my faith in other people's hands, especially Wall Street analysts who as a whole are so consistently wrong with their estimates. I also have no idea who this particular analyst is or how well they understand the company, so I'd much rather estimate the growth rates myself. Growing cash flows into the future yourself is tricky because you're trying to predict the future, which is immensely difficult. And this is where understanding the business you're trying to value is critical. It's important to understand that valuations are just guesses by nature. So we're trying to guess and be roughly right rather than precisely wrong. We saw before Alibaba's free cash flow was down year on year by quite a lot. And if you didn't understand the business or follow it closely, this might seem concerning. Essentially, all that happened is Alibaba, along with Tencent, were asked to pledge around $15 billion to the Chinese government as a common prosperity gift to help underdeveloped regions in China. And then there was also a one-time fine of $3 billion for monopolistic behaviour. Because I've spent months researching Alibaba and I understand the business, I feel like this isn't really going to hurt Alibaba's business in the long term. So for the first growth rate, which is the first 5 years, I'll be conservative and estimate Alibaba grow their free cash flow by 10%. Which would get them back to a little over 30 billion by 2026. I think this is pretty conservative and Alibaba could easily get back to 30 billion before then, but I'll use 10% to be safe. For the following 5 years, I'll assume the growth slows down a little, but because I think the cloud business and some other bets will be starting to hit scale, I'll use a growth rate of 8% for years 5 to 10. Next we need to discount the future cash flows back to today using a discount rate, and I always just use 10% to keep it simple, and it's what Mohnish Pabrai used in the Dando Investor. Next, we need our terminal value or terminal multiple. You can think of the terminal multiple as the multiple the business sells for in its 10th year, when we sell the entire business. And the multiple is based on the free cash flow in year 10. So you might pay 10 times cash flows for an average business, and for a wonderful fast growing business you might pay 20 times cash flows. Think of it like a PE ratio with free cash flow instead of earnings. I try to estimate a fair multiple based on the quality of the business. So I use a multiple of 5 to 10 for mediocre low quality businesses. I use a multiple of 15 for high quality businesses with little to no growth. And for high quality businesses with big growth ahead, like Tesla, I use a multiple of 20 to 30. It depends business to business. For Alibaba, because I consider them quality and they have slowing growth, I'll give them a terminal multiple of 15. And to finish our calculation, we just need the shares outstanding, which if we go back to Ticker, we can see is 2.7 billion. So the calculator's done its thing, and based on my estimates, Alibaba's intrinsic value for the entire business is around 490 billion, and per share it's around $182 a share. And for those Graham style investors looking for those 50-cent dollars, the 50% margin of safety price is around $91 a share. So that's my conservative estimate for Alibaba's intrinsic value. Now, before I move on and try to value Tesla, I just want to point out that the more complicated the company you're trying to value is, the harder it is to accurately value. And Warren Buffett is famous for throwing complicated companies in the too hard pile, when they're too difficult to forecast. Trying to value Tesla or Amazon or any complicated company is extremely difficult, and it requires way more research and understanding than simple companies. So when I show you these estimates for Tesla, please keep in mind that I'm skipping over hundreds of hours of research, and I'm just showing you guys the end results. Again, these are my own estimates, and I'm just some dude on YouTube trying to predict the future, so please don't take this as a buy or sell recommendation. If you're interested in a full 20-minute breakdown of my valuation analysis for Tesla, I'll link the video in the description box below. So with Tesla, I like to use other valuation methods, which I used in the other video. But if I do use a discounted cash flow for Tesla, I use it in a slightly different way. Instead of using growth rates to predict the future cash flows, I prefer to just predict the future cash flows myself. To do this, I'll quickly skim over how I estimated their cash flows 10 years into the future. First, I estimated their production capacity until 2031. Then I used an average sale price to get auto revenue for 2026 and 2031. Then I estimated the future energy revenue and subscriptions to get total revenue for 2026 and 2031. Once I have my guesses for total revenue, I simply add a reasonable free cash flow margin to get my future free cash flow. For 2026, I used 10% because it's pretty conservative. Tesla already achieve a 10% cash flow margin today, so I actually think they'll be way more profitable in a few years, but I'll use 10% to be safe and add a margin of safety to my calculations. For 2031, I used a 14% free cash flow margin to reflect Tesla's insanely profitable business model hitting that critical mass and reaching full scale. Again, I think 14% is very conservative and it could be a lot more. So that gives us a free cash flow estimate of 34 billion for 2026 and 69 billion for 2031. And you'll see why I marked them green in a second. Now, if we go back to the DCF, I already have our current free cash flow filled in. So now we just need to plug in growth rates so both of these green boxes match our estimates from before, which was 34 billion and 69 billion. For the first 5 years, to get 34 billion, our growth rate has to be 47% per year. And for the following 5 years to get 69 billion in 2031, the growth rate has to be 15%. So now we have our growth rates and free cash flow estimates. So to finish the valuation, we just need the terminal multiple. Now, 10 different people will have 10 different opinions on what Tesla's multiple should be. But because of its long runway, its high return on capital, and its growth, I'll assign it a terminal multiple of 30. So this gives us an intrinsic value market cap for the entire business of 985 billion, or around $985 a share. And to get Tesla for 50% off, you need to pay around $500 a share. So that's my estimate of Alibaba and Tesla's intrinsic value. I really hope you found this style of video useful and you can start performing your own valuations. As always, if you want to download and use my intrinsic value spreadsheet to use yourself, it'll be available to download in the description box for free. And if you have any questions, please don't hesitate to let me know in the comments below. If you enjoyed the video and you want to support the channel, I'd really appreciate it if you hit that like button. And if you want to see more videos like this one, then hit that subscribe button. If you're still bored, I'll put another video up in the corner that I think you'll find interesting. If you've watched the video all the way to the end, thank you so much for watching and I really appreciate your support. If you're new to investing and you want to learn how to invest using the Buffett Monger framework, then check out the free course on the channel. And as always, this video is not financial advice and I'm not a financial advisor. So please always do your own research before making any investment decisions. So that's it for today. Thank you so much for watching and I'll see you guys in the next one.